Hello and welcome. This video will be on market maker models. So this will be an introduction to market maker models. So first and foremost, I want you to conceptualize this pattern inside of your subconscious. So I want you to think about this pattern clearly and look at this pattern as every stage in either a distribution of buy stops to sell stops or a reaccumulation of sell stops order to pair with resting buy stop orders. So this market maker models, this is how the algorithm delivers price from this market maker models. This is how the algorithm pairs up price. This is the indication of the participation by the market makers. This is how they pair up liquidity from both sides of the market, from buy stops to sell stops. So when you have this model in your arsenal, it gives you a framework to understand in what stage is the market makers currently operating on. In what phase are they currently distributing or accumulating price in that body of price action. So understanding this market maker model, this pattern, it gives you a clearer vision to understand those phases in which the price is currently trading inside of. So generally, price starts from a consolidation from the element of a trade setup. We noted that price starts from a consolidation. So every start of every price action or every algorithm, when the algorithm starts spooling, it starts from a consolidation. Then you get an expansion leg. And when you get this expansion leg, price will trace this back down to the order block, resting at the midpoint of this consolidation phase, which is the initial consolidation. Then price rallies higher and then goes into a form of consolidation, and then you have the second stage of this reaccumulation, because this, when price dropped lower here and retraced back to this order block or a fair value gap resting after this expansion, that was the first stage of this reaccumulation phase, because you must first have a draw on liquidity on the higher time frame as to where you're expecting the higher time frame candles to draw towards to. So when you have that draw on liquidity, then you start working with these market maker models. So when this low is taken like this, for example, then this liquidity that has been purged on the sell side will now be used to pair up the buy stop order resting above these highs, this hold highs here. So and then price will expand higher. Let's say above here we have buy stops, which is buy side liquidity. And below here we have sell stops. These market maker models, It is how the algorithm operates in its phases to accumulate price to go higher for buy side delivery, and also to distribute price to go lower for sell side delivery of price. So after the first stage of distribution and the second stage of distribution, price will then rally higher to neutralize those buy stops orders which is resting above buy side liquidity, and price will go into a form of consolidation. And after this consolidation, you have a form of smart money reversal that will form when price has reached its reversal stage at a higher time frame PDRA. So an SMT divergence. So you correlate this when you are using the market maker models. You have to have an understanding of intermarket relationship, of intermarket analysis, to understand the correlation between those assets, either a an inversely correlated asset or a directly correlated asset. For example, if you are tapering the ES, which is the S&P, the closely correlated market is the Nasdaq. So when there's an impending reversal, there will likely be an SMT divergence during this consolidation phase, when at a higher time frame PDRA, when the market is expecting a form of reversal. So you have that here. So the market will then drop lower. With this expansion leg lower, you have an order block or a fair value, an order block resting at the midpoint of this consolidation phase, or a fair value gap resting at this imbalance which was created from this expansion leg lower. So price will then retrace higher to balance that imbalance or trade inside of that order block, and then price will drop lower. Now this is the first stage distribution. After price drops lower, price will meander around here and then create a form of entry model for traders that missed this first stage distribution. To understand these market maker models, you must first understand market structure. This is why I was emphasizing and overemphasizing on the market structure lessons, because for you to understand these market maker models, you must understand the concept of a long-term highs and long-term lows, and also, more importantly, the intermediate term highs and the intermediate term low. That intermediate term high that has balanced an imbalance that was created after this expansion leg lower, that intermediate term high is the first stage distribution, and you would not want to see price to trade above that first stage distribution when you are expecting lower prices for a market maker sell models. So if you miss the first stage delivery, the first stage distribution, or you are wanting more confirmation after a first stage distribution, when price drops lower, price will leave a order block or a fair value gap also here, or other times it will leave relative equal highs here, and then price will use these relative equal highs now to pair smart money sell orders and then drop lower to a form of original consolidation. Does that make sense? And then price will go into a consolidation phase. So price does one of these things. So here you have the first stage accumulation. So you have the first stage distribution, which occurs here, and then price goes into a second phase of distribution. That second phase of distribution is synonymous with the short-term swing points after an intermediate term high or an intermediate term low has been established. So that second phase of the distribution of that market maker models, that is where you want to participate in the market, expecting price to not violate the first stage distribution high, the swing point which was created during the first stage distribution. So this is the basic understanding of the market maker models. This models is fractal in price action, and it goes on from a higher time frame down to a lower time frame PDRA. So when using these market maker models, you must be conversant with the you must understand the time frame, each subordinate time frame which you want to see this fractal nature of price action appearing. So for example, if your higher time frame is, let's call this the higher time frames, and here you have call this the higher time frame, and here you have the lower time frames. So the higher time frames first, then the lower time frames, which is subordinate to that higher time frame. So when you have a market maker model on the daily time frame, when you have a market maker model on the daily, you'd want to see a fractal nature of that market maker model on the 15-minute time frame. The 15-minute time frame is the bellwether time frame for the daily higher time frame. You'd want to see 15-minute fractal, and when you have a higher time frame of 4 hours, this is contextually, so this is not a dogmatic statement. You'd want to practice this more to understand what is the bellwether for each individual higher time frame. So when you have if you're trading the 1 hour as your higher time frame, the subordinate lower time frame where you'd want to see this fractal nature of price action take place is the 1 minute time frame. So the 1 minute will be your lower time frame for the 1 hour, when the 1 hour is the higher time frame. And when you're using the 15 minutes as your higher time frames, the 30 seconds and the 5 seconds chart will be your lower time frame. That is the 5 seconds and the 30 seconds. So this is for aggressive scalpers. This the second chart is for traders that can make decision quickly. The 15 minutes, the 1 hour higher time frame, and using the lower time frame, using the 1 minute as the subordinate lower time frame, this is for scalpers. The daily, using the daily as the higher time frame and the 15 minutes as the lower time frame, this is for intraday traders that trade intraday models. While if you are a swing trader, you focus on the monthly and the weekly time frame as your higher time frame, and then use the daily and the 4 hour as your bellwether chart as your lower time frame for looking for a fractal nature of the market maker models, which was formed on that higher time frame. So you'd expect the fractal nature of these market maker models to occur at the subordinate lower time frame, using this as a framework to understand this. So let's look for a quick example. On the daily time frame, you have something like this. You have this here as the original consolidation, then here you have the accumulation phase, and here you have the smart money reversal phase. You have a reversal stage here. And if you look at this right here, this is the first stage distribution. Sorry, this is the first stage accumulation here. This fair value gap here, this was the first stage here, and then you have this second stage trading inside of this fair value gap here within this imbalance here. So this is the second stage before price valued higher, and then price went into a form of consolidation. And when it does this, it drops lower and leaves an imbalance here. And also this set of last up close candles, this consecutive up close candles on the higher time frame, probably the weekly time frame, this will be seen as one candles. The algorithm will see this set of up close candles as one individual candles. So right here is the daily bearish order block, which have an imbalance here, which makes this a higher probability order block. So when price drops lower, the first stage distribution occurred here. So we had this first stage distribution of price trading inside of this PDRA, which is this fair value gap, this imbalance which was created here. So when we had this first stage distribution, price dropped lower here. This is the original consolidation we're expecting price to draw to. So our draw on liquidity is this low, which coincides with this relative equal lows here. So here you have clean lows here, which are relative equal lows. Here you have buy side liquidity resting here, which is a clean high. So now going into this Monday's trading, for example, using this daily time frame as the higher time frame, going into the bear order of this higher time frame, you go to the directly subordinate lower time frame, which is the bear order for the daily time frame, which is the 15-minute time frame. So when you go to the 15-minute time frame, you would have, so this is the daily delineation of this daily time frame of this 29th of July. From the higher time frame, we've observed that the first stage distribution has occurred, which is this. From the higher time frame, we noted that the smart money reversal has taken place here. So here you have ES taking this high here, and for the indices, for the Nasdaq fails to trade above this high. So you have to go into your chart by yourself to look at this, to check the relationship between the ES and the Nasdaq. So when you have that here, now this consolidation from this low to this high now is the initial consolidation. So when this consolidation occurred, price dropped lower, and then you had this first stage distribution. Now because from the higher time frame, price is seeking a second stage of distribution in that higher time frame chart. From the lower time frame chart, you'll be also seeking a fractal nature of a second stage distribution on that lower time frame chart. Does that make sense? Because the market maker models are fractals. So you have these highs here, this clean highs here. It will be seen by uniform money as a resistance, like a strong resistance. So these highs here will be a strong resistance for them, and they will place their stop losses above these highs, which will be resting as sell stop orders. So here, sorry, as buy stop orders. So here you have buy side liquidity resting above here. And now on the opposite side of it, from this low to this, from that high to this low. So here you have a clear discernible consolidation phase here when price rallied higher and trade back down into the other block, which is resting at equilibrium of this consolidation phase. If you remember from the video of elements to a trade setup, so we have this and price rallied higher. Now, because you are expecting a second phase distribution in price from the higher time frame, when you drop down to the lower time frame to the bellwether time frame to the higher time frame, you be interested in looking for if that fractal nature for lower prices. So here you have this swing low resting. You have this swing low resting here because the traders that bought here when price rallied higher here and dropped lower here, they will scale their stop loss position higher and remove it from this position and raise it higher to this price point, expecting higher prices, expecting price to go for higher prices. So there is stop losses resting below these lows, which are resting as sell stops, which is sell side which is resting as sell side liquidity. So you have sell side liquidity resting below these lows here. So, and when you are using the market maker models, especially as an intraday trader or a scalper, you'd want to participate in the marketplace during a Q zone, because that is when you have higher probabilities and injection of liquidities inside of the marketplace. So let's continue. Because from the daily time frame, we are anticipating a second stage distribution in that market maker sell models. When you drop lower to the bellwether of that daily time frame, which is the 15-minute time frame, you will go into the price action seeking and anticipating a second stage distribution of that market maker sell models. You have this smart money reversal taking place here. So when the smart money reversal has taken place, you go into the price action and identify the first stage distribution that has occurred. So the first stage distribution is price rebalancing this imbalance here. So when price dropped lower here, it left this other block, which is this consecutive or close candles here. So your price left this other block here. So here it will be noted as the first stage of distribution in price. So here you have the first stage, and when you are anticipating the second stage distribution in price, you do not expect this high, which is this intermediate term high balancing this imbalance. You do not expect price to trade above this imbalance here, sorry, above this swing high here. So when price drops lower from this candle now, price, this is the opening price here down, and then price drops lower and made a form of swing low here. So this swing low to this swing high, when you anchor your Fibonacci from this swing low, from this swing high to this swing low, you have something like this. And then price will trade up to this other block because this low has not been violated. Price will, when price retraces higher for the second stage distribution, price will trade higher to a bearish order block, which is this, which is the second stage distribution. So you are currently interested in this bearish order block for a second stage distribution to distribute smart money sell orders to the downside. So this second stage distribution, it is what you are interested in, and because you are looking for a second stage distribution from the higher time frame, when you drop down to the lower time frame, you are also anticipating and participating in the second stage distribution of a lower time frame fractal. So to have a clear view of this here, to have a precision entry of this here, we drop down to a 5-minute time frame. This right here is the 5-minute time frame to get a precision entry for an intraday trading model. So here is the first stage distribution. As you can see, price dropped lower here and left this imbalances here, and also this other block, this consecutive or close candles. So this was the first stage distribution in price. So when you drop lower to get a cleaner and more precise entry for stop placement and trade management, you look for that fractal which you're anticipating from the higher time frames. You look for that fractal also in the lower time frames, which is the second stage distribution. So when you have a second stage distribution in price, when price trades here, so this right here is the intermediate term high, so you do not want to see this high violated. So this high now is now your invalidation point because it has already made its first stage distribution in price. So when price drops lower, you are anticipating a second stage distribution for traders that miss this first stage distribution in price. So you would want to be a participant of this second stage distribution because that is what you are anticipating from the higher time frame market maker model. So here you have this fair value gap which is resting here, and price trades inside of that fair value gap and then dropped lower. This is the second stage distribution taking place at the lower time frame, which is a factor of that daily time frame market maker model. So you enter from a PDRA, from a premium PDRA here. So if you take your fib from this low, from this swing point, let's use the bodies, from this high to this low, you have this swing point now here which the market has created. This is a clear discernible range because this high to this low, it has been balanced. The price has delivered a premium price to balance this imbalance which was created here. So this price action now is a balanced price action. So when price drops lower now, price needs to balance this price action now. So to balance this price action, price will trade higher. So this trade higher now is the short-term high. This short-term high now, you do not want a short-term high to violate an intermediate term high. If a short-term high violates an intermediate term high, that is price telling you that your narrative, your view of price action in that current time frame is wrong. So if this intermediate term high is violated, especially with a body close, this is price telling you that you are on the wrong side of the market. So price trades to a premium PDRA from this low to this high. This is equilibrium, and price trades to this premium PDRA here and then distributed to the downside below these lows, and almost to this low. As you can see, we're about 0.5 handles, that is half handles away from this low, away from this sell side liquidity. So when you have a pool of liquidity like this, you do not expect price to always and every time trade below that your sell side liquidity for you to be profitable. So you want to create systems of scaling out your trades. So one of the systems for scaling out of trades is to identify PDRAs, significant PDRAs from the higher time frames down to the lower time frames. So when price trades, if you are bearish, you are looking for sales. When price trades to a premium PDRA, you are selling from those premium PDRAs. And when you want to take profits or you want to take partials, you'll be taking partials from a discounted PDRAs. And when price was inside of this fair value gap, from the video on premium and discount, we noted that every PDRA below the current market price, below this current market price when time was 10:15 a.m., the premium PDRA is below the current market price was this lows here, this volume, this liquidity void here, and this week. Weeks are imbalances. So if you take these weeks and you measure the high of the week and the low of the week, you'd want to scale out something at this equilibrium point of this week. So you indicate this as a discount week's consequent encroachment. So you want to indicate this week as a discount consequent encroachment week. Does that make sense? So when price trades to this consequent encroachment, you want to take your trade off. Either collapse all of the trade or you take some partials from this price level, which is about 5480, down to this price level, which is 5425. Sorry, 5452. This is about 28 handles, mixing 5 handles. If you're mixing about 5 to 6 handles, getting 28 handles, this is okay, this is fair. It's about 1 to 5 risk reward ratio. So you should have already scaled something off, a significant portion of your price of your position off at these lows, this liquidity void, and also this, because all of these PDRAs, they are discounted PDRAs which are below the current market price. The current market price was here. All PDRAs below a current market price is a discounted PDRA, and you want to scale off your positions from those discounted PDRAs. Okay, so this is an introduction to the market maker models. I hope you got something from this video, and we'll talk to you next time. Have a nice day. Goodbye.